Hi everyone and welcome to Defi Daily, the channel where every day we talk about DeFi, going through different analysis, tutorials and news. Today we're going to talk about how to avoid the liquidation. Being liquidated is probably the worst scenario that can happen to you. And the reason is because you will have to pay some fee that can be from 1 to 2% to up to 15%. And on the other side, you will also at risk of losing some important opportunity and ruining your capital. So it is something that you have to pay really attention. And being liquidated is something that you are at risk of every time you are borrowing some crypto, and also every time you are using some platform like Solfarm. I made also a complete overview about it, and you can find it here in the right corner. You will find the link. Or also Alpaca Finance. All of these platforms are allowing you to use some leverage to farm, and you are also, every time you are using some leverage, at risk of being liquidated. And we will discuss exactly how to avoid it and how does it mean keeping a safe collateral ratio. What does it mean choosing the safe amount of leverage, the safe amount of risk that is the optimal to maximize your returns. Before to start, I would like also to ask you to subscribe to the channel, and please leave me also a thumb up to help me spread the word, reach more people and grow the channel. It is just a small action by you, but really means a lot to me, and also it will help the channel to grow and to sustain my work. So I would be more than grateful if you would do it. Remember that all the contents in this channel are just for educational purpose and nothing has to be intended as a financial advice. If you want to invest in anything, that could be great, but please do always your own research first. Okay, liquidation. Let's take, for example, the situation where you want to borrow some crypto. If you ever used a platform like this could be a money market like Aavee, Qubit Finance that I made a video on it, Benqi, or all the money market that are allowing you to borrow some crypto. In all of these cases, you would have to choose a collateral ratio, a loan to value. It doesn't matter how it is called in each specific platform, because this kind of feature, this kind of threshold could have different names for each platform. It doesn't matter how they call it. What is important to you to know is that no matter what, you have to choose an amount. So the amount of money, the amount of cryptos that you are borrowing, so your exposure, need to be safe. Safe means that you will not be liquidated. Because let's say, for example, that you have $100 of any crypto and you use them as a collateral. And in this moment, you are also borrowing some other cryptos. Let's say that you are borrowing a 50% against your collateral. So you are borrowing just $50. Everything is fine until the value of your collateral, so of the cryptos that you are using to guarantee the amount of crypto that you are borrowing, is going up in value. Let's say that you are using Bitcoin as a collateral and Bitcoin is growing in his valuation, so the value of your collateral is growing and you are safe. But what will happen if the value of your collateral will dump? In this case, your guarantee, what is guaranteeing your borrow, is going down in value. It means that the platform where you are borrowing your crypto is considering you less secure. Because remember that all of these protocols have just a goal. They have to be sure that people will be always able to repay their own debt. So how we can avoid to being liquidated? To answer to this question, we have to keep in mind the volatility, because the problem is not the amount of cryptos or money that we are borrowing. The problem is that cryptos are so volatile that the value of what we are borrowing and the collateral that we are using can change any moment soon. We have seen days where the cryptos has done a 3x, but also days where just in a couple of hours a crypto has lost something like 60% of his own valuation. And all of this volatility is really bad from a money market point of view, because in the moment when you are supplying an asset as a collateral that is so volatile, especially if the volatility is going down, if what you are providing as a guarantee can lose value so fast. This is something that is high risk, because if you are believing that to have $100 as a guarantee, you are at risk not even a couple of hours to have just $50. So in the moment when you have to choose your safe amount of cryptos that you can borrow, you have to do some small calculation, and it's something that could go even beyond to what could be suggested by the platform, because you probably have noticed that many platforms are saying to you, this is a safe amount of cryptos that you can borrow. Okay, you don't have to be misled by this claim, because most of the time what they are considering safe, it's not really safe. It still have a really high risk, even if they are saying it's safe. Let's use, for example, the case of Anchor Protocol. I made also a complete video on Anchor Protocol if you want to know more about it. Today, what I really care is just to help you understand how does it work, the liquidation, and why the safe threshold could be much different from what the platform is saying to you. Okay, let's take this example. When you are borrowing some cryptos from Anchor Protocol, they are saying to you, if it is 100 the amount of your collateral, you can borrow at maximum 60%. In the moment when you are going beyond this threshold, beyond this 60%, you will be liquidated. On the same time, they are saying to you that a safe amount is 40%. Is it true? Is it really safe? Let's try to calculate. And for example, what kind of collateral you can use on Anchor Protocol? You can use Ethereum and Luna. I will use Luna as a collateral in this example just because it is an asset with a higher risk, because it has a higher volatility. But the same process, you can use it for any kind of asset. You have just to adapt the metrics, the value, to the value that are typical from that kind of asset. In any case, don't worry, because at the end of this process, it will be everything much more clear. Okay, let's use Luna. And let's say that we at the beginning, we are considering safe our 40%. And let's try to have a look to the chart of Luna. And you will see, if you have a look to it, that the price of Luna can change even by 50%, could dump even the 50% in not even a couple of hours or a couple of days. So if the price of Luna decrease by 50%, what will happen to your collateral? What will happen to your safe threshold? It will be really safe, or you will be liquidated in any case. Let's calculate it. So we know that if we have $100 as a collateral, we will be liquidated in the moment when our what we are borrowing has a value more than the 60%. So we provided $100 of Luna as a collateral. We know that in the moment when the amount that we have borrowed reached the $60, we will be liquidated. So for this reason, we chose to borrow just $40. But what will happen if the price of Luna, as we saw from the chart, dump by 50%? In this case, our collateral will reach a value of just $50. But on the other side, our debt is still $40. What does it mean? It means that in this case, 40 on with a collateral of $50 is much higher than the threshold of 60% as we have to keep in this platform. So as you can understand, even if they are saying that the 40% is a safe amount, that's not true, because a real safe amount would be an amount that is guaranteeing to you that you will be covered even if the price of Luna will dump by what is typical for this kind of asset. And as we have seen, a dump of 50% into the price of Luna is something that is quite typical, unfortunately. And that's the reason why the safe amount, it's not really safe. A safe amount in this case would be something like the 24%. Why 24%? Because let's say that we have provided $100 as a collateral and we are borrowing just $24. In this case, even if the price of Luna dump by 50% and reach a value and reaches a value of $50, in this case having borrowed just $24 is still less than the 60% of our collateral, so we will not be liquidated. And remember that this kind of calculation is really important, because in the crypto market, flash dumps are quite typical. And the problem with flash dumps is that the price is crashing so rapidly that you don't have any possibility to change the amount of collateral, because it's happening so fast that you don't have the time to change any kind of metrics, any kind of collateral from the platform that you are using. So you can just stay and hope that you will not be liquidated. But the problem when if you will be liquidated, it's not only that you have to pay the penalty, but you are also losing the pump that is happening every time after a flash crash. Because what is typical in this market is the price that is going from, let's say, 100 to 50 in just a matter of a couple of hours, but in not even another half an hour it could reach again the level of, let's say, $70. So it's going 150 and then again 70. So the problem is that even if the price at the end is 70, if in the journey from 150 you will be liquidated, you will lose the ability to take advantage from the pump that will come later and after the crash. So in the worst scenario, you will be liquidated in the moment when you reach the 50. So let's say, for example, that you had inside the platform, to the Fly platform, $100. The price goes down to $50 and the platform will liquidate you at this price. So you will have only $50 in your wallet minus the penalty fee that could be even 10%. So let's say that in this moment you will have a portfolio that has just a value of $45, because it's the 100 from 100 less the 50% less again another 10%, and it makes 45%. The problem is that not even a half an hour later the price of your old cryptos could reach the amount again of $70. And that's really a shame, because instead of having $70 in your portfolio, you will have just $45. And that's how does it work. And that's the reason why you have to keep really a close attention to the safe amount. Don't just say, okay, they are saying that it is safe, I can choose maybe a little bit higher so I can even speculate more. Don't just fall in love with speculation and with higher returns. The first rule is keep safe your funds. If you are losing your funds, you are out of the game. And that's the reason why you have to defend them. and you have always to choose a real safe threshold. A safe threshold that you can decide it accordingly to your strategy. That's clear that if you want to stay in the position just for a couple of hours, you can choose even a higher amount, because the probability of a flash crash just in the hour that you have just opened the position is less probable, or in any case, having just a so short amount of time, you will be on the plateau, so you will be able to react faster and correct your position. On the other side, if you are choosing some longer duration, you will have to keep in mind what kind of volatility the asset that you are choosing as a collateral could have. So choose an amount of the amount that you want to borrow that is really safe, that is not putting at risk your position, because at the moment when you will be liquidated, you are out of the game. You are really losing a lot. So that's the reason why you have to choose a safe amount. So step one, you have to check the volatility of the asset that you are using as a collateral. In this case, in this example, we have used Luna, but the same process you have to use it for all of the other cryptos. It is going for Ethereum, Bitcoin, and so on. So you have to look at the chart and check the higher volatility that this kind of asset can have. So let's say that if in the last year it happened that the price has gone down just in a week by 60%, you have to keep in mind that 60% is a possibility. So a really safe amount is the amount that will not be affected, so you will not be liquidated even if this kind of event will happen. Once you have done this, you have also to check the volatility of the asset that you are borrowing. My suggestion is that it's better most of the time to just borrow a stable coin, so you don't have to worry also about the volatility of the asset that you are borrowing, because let's say that you are borrowing Bitcoin and the price of Bitcoin is pumping. Even if the price of your collateral is not dumping, the story is the same, because the value of your debt will go up, but your collateral will stay stable and you will be liquidated in any case. Because what really matters is the relationship, it is the ratio between your debt and your collateral. Another strategy that you can use to avoid liquidation is just to borrow the same type of asset that you are using as a collateral. Let's say that you are providing as a collateral Bitcoin. If you are borrowing Bitcoin, you will not be liquidated, for the simple reason because the relationship between the value of your debt and the value of your collateral will stay stable. In the moment when you will have received your Bitcoin as the Bitcoin that you have just borrowed, you can do whatever you want with this kind of Bitcoin. You can even sell them, receiving some stable coin, and invest in something else that you believe will perform better than Bitcoin, or just take the Bitcoin and add them to a pool and start adding some rewards and so on. You can do whatever you want. What I really care in this moment is to make clear that if you are borrowing the same kind of asset that you are using as a collateral, liquidation is not anymore a problem. On the other side, if the crypto that you are borrowing is different from the crypto that you are using as a collateral, liquidation, it could be a really big problem, and that's the reason why you have to keep really for real a safe amount of borrowing. Okay, let's just try to recap what we have said. Remember, first of all, liquidation is a big problem because you are not only losing your position, but you will have to pay some penalty, and you are at risk of losing also the ability to take advantage from the flash pump that most of the time is happening after a flash crash. So to avoid it, you have to check the chart, looking for the maximum volatility of a certain kind of asset, and take as a possibility the fact that this kind of dump could happen any moment soon, and you would have to be able to defend your position even in case of this happening. Another strategy to avoid being liquidated is choosing the same kind of asset that you want to borrow, that is the same type of what you have provided as a collateral. Guys, that's all for today. Just keep a close eye on liquidation, because it is really the worst scenario when you are borrowing and when you are using a DeFi platform. As always, if you have any kind of question, just write me in the section below. And please leave me a thumbs up, and I will see you tomorrow with another video. Bye guys.